Good evening, everyone. Thank you for taking the time to join our webinar tonight. We are currently live at Hangouts at UOB at Ngee Ann Polytechnic. This is a community space launched by UOB and Ngee Ann Polytechnic to nurture startups and student entrepreneurs. My name is Jaime, and I'm a management associate at UOB, and I'll be your host for tonight. More importantly, I've just started my investment journey, so like everyone here, I'm very curious to learn how I can be a better investor. So with us tonight to share his experience is Jaime Liew, a portfolio counselor with UOB. Jaime, would you like to share with everyone what you do at UOB?
Thank you, Jaime, and a very good evening to everyone. Thank you for taking the time to join us tonight. So I've been a portfolio counselor with UOB for the last 7.5 years, and my main role is to work very closely with your client advisors to analyze and advise on our clients' investment portfolios. Some of my other duties involve contributing to the investment research of the bank via the investment committee that publishes the semi-annual market outlook that some of you may have read today. So my investment journey started about 15 years ago, and during that time, I was probably asking the same questions that you would have on your mind now. Is it the right time to invest? How much should I invest? Is investment risky? What type of investment should I get into? And although I've been in the industry for 12 over years, my investment journey really started no differently than anybody over here. So tonight, it is my pleasure to actually share those experiences, some of the mistakes that I made along the way, and hopefully give everybody here a bit more confidence about taking that very important first step, or even to build better portfolios in the future.
Thank you, Jaime. So before we start, I would like to go through some housekeeping matters so that everyone will have an enjoyable viewing experience tonight. So please rest assured that measures are in place to ensure that this webinar is filmed according to safe management guidelines. Also, a big thank you to everyone who sent us your questions ahead of time. We'll try to answer as many of them as we can. For those of you who haven't had the chance to send your questions to us, don't worry. You can submit them at any time during tonight's session. Click or tap on the Q&A button at the bottom of your screen, and a window will pop up for you to enter your questions. And don't worry, no other viewers will be able to see your questions. All right, without further ado, let's dive right in. Now, the title of tonight's webinar is Things I Wish I Knew About Investing. That definitely applies to myself and the audience. But more importantly, Jaime, it applies to the lessons you said you learned since you started investing 15 years ago. Could you share those experiences with us?
Yep, definitely. Well, back in 2006, when I first started investing, it was a pretty good year for stocks overall. I didn't really knew what I was buying at that time, but I knew I was making money. And of course, me being very young and naive back then, I thought this was because of my own skill rather than what it really was, which was just sheer luck. So I didn't really think about why I was investing at that point in time. I only knew I wanted to make money. So if I wanted to buy something nice for myself, I could actually make the money just by trading stocks in the open market. Now, I never thought about the risk that I was taking, or what was my investment objective, how long was my investment time frame, or even why did stocks move the certain way that they did. I didn't pay attention to the market or the economy at all. So I was quite happy with very small returns back then. But of course, as you know, as we get a bit older, the ticket items we want start to get a little bit bigger. So then I had a friend who introduced me to margin trading or leverage trading. And I thought, what a brilliant idea. If I'm really so good at investing in stocks, why not leverage to double or triple my returns, right? So then came 2007. There were already warning signs, right, that something was brewing in the markets itself. But I didn't really pay attention to this. I was just enjoying the party. But before long, the music was about to stop. And then came 2008. So back then, I didn't believe that the markets would continue to tumble, right? But when the dust finally settled, since the market started falling, it was about 16 months. And this brings me back to a historical situation, right? So this happened in the Monte Carlo casino back in the 1913. And they called it the gambler's fallacy or the Monte Carlo fallacy. So what actually happened on that single night alone, for those of you who understand how roulette is played, you can basically bet on either black or red. So let's say you walk into the casino or fancy, walk up to a table, and you see that it's been 10 times or 10 rounds black. What's the logical thing to do? You would buy on red. I think anybody here would. So a lot of gamblers for that night actually did that, right? And they continued non-stop. And that same evening alone, a black came out 26 times in a row. So you can imagine in 1913, millions of dollars were lost just on that single night itself. Now, what this actually explains is that sometimes we place too much emphasis or focus on past events to actually predict a future event. And that's exactly what I did. I didn't believe stock markets would fall. I continued to invest, I continued to leverage. And when it all came crashing down inevitably, the brokerages started knocking on my doors, asking me for more margins to be posted. And honestly, at that point, I ran out of cash. So looking back into 2008 and 2009, I don't regret losing money as much as not having the cash to take advantage of the opportunities when markets eventually did recover. So I started from ground zero all over again, and it was a very painful process. But this time I knew not to make those same mistakes again. First of all, I wanted to build a very strong foundation first. So if you think about wealth as a pyramid, right? You want to start building the foundation first. And once that is strong enough, you continue building the layers upwards. Now I realized back then, I kind of built the pyramid this way. So I kind of started at the tip. And you realize very quickly that once that starts to crumble, everything just falls to pieces immediately. So ideally, I took a much more disciplined approach. For my foundation, I wanted to make sure I take care of my protection needs, my savings, have enough liquidity, basically have a much wider safety net. And once I had that in place, then I thought about a strategy to build the pyramid upwards and start to enhance my wealth portfolio going forwards. Needless to say, I spent a lot of time investing in financial education over the years, and it was a very long and very interesting journey. But had I been more disciplined at the start, it would have been much easier to rebuild my wealth, starting somewhere in the middle rather than right at the bottom again.
I see. Can I go back to what you said about being clear from the start about why you're investing and like how much risk you're comfortable with taking and your time horizon? What do you mean by that?
I think most first-time investors, they will always feel that investments are very complex, very complicating. But I believe that they can really be simplified into very simple concepts. For example, every investment entails three very simple factors. You have returns, risk, and time. Now, in the perfect world, returns are very high, your risk is very low, and the time frame is very short. But that may be a little bit hard to come by. But if anybody in the audience knows of such an investment idea, please call me right now, okay? So you need to consider, or rather prioritize, what factors are the most important to you. So for example, Jaime, if you were to buy a house in 1 year's time, I think liquidity should be your most important, right? And of course, you probably wouldn't want to take on too much risk, and your time frame is pretty short. So you reasonably have to expect that returns may not be so high. And I think this is where a lot of first-time investors, they fall victims to investment schemes that promise you a very high return in a very short amount of time. But you don't really, most people may not understand what are all the underlying risks for that particular investment. So say you're a first-time investor, how do I get started? Okay, on the screen right now, what you see is what I believe are three time-tested investment principles. Okay, first of all, stay invested. Secondly, invest regularly to benefit from dollar cost averaging. And lastly, benefit from diversification, right? So in terms of investment objectives, right? Okay, there are many ways we can approach this, but we can classify them as, firstly, playing it safe, meaning that you're going for liquidity. Or maybe you want to find some balance, go for income investing, because traditionally income investing tends to be a bit more stable as opposed to capital investing. And via a balanced portfolio, you want to seek out the regular dividends, kind of get that consistent returns going for your portfolio. Then for the growth portfolio, for investors who are seeking much better investment opportunities to really take their wealth to the next level. So I think all three investment objectives are equally as important, and we've covered the liquidity objective. And let's say for my parents who are retiring, income would be a little bit more important for them. They want to monetize the assets that they have worked so hard to save over the years. They may be able to take on a little bit of risk, but not too much. So I think balance is more important for them, get some cash flow for their retirement years. For myself, I am planning for a retirement, so I want to rapidly grow my assets. So growth will be one of the key focus points for my investments. Of course, all three factors are equally as important, and I do not invest 100% of my assets into the growth portfolio. I do keep a fair amount of liquidity just so that I can capture future market opportunities as well.
I see. That's really interesting, Jaime. So after I've understood all of this, what's a good way for someone to start investing? For example, how much money should you invest? And how do you decide when's a good time to take that first step?
Well, definitely the best way to invest is to come to UOB and have a chat with us, right? Okay, but for a first-time investor just starting out, remember just now I mentioned about 3 time-tested investment principles that you can undertake. So just to recap, is to stay invested, and to invest regularly to benefit from dollar cost averaging, and to diversify your investments to create more consistency. So first one, stay invested. Now let's paint a hypothetical scenario. Let's talk about the worst investor in the world. Let's call him Jaime. And over the last 15 years, Jaime managed to invest in the S&P 500 index. That is a US stock market index that tracks the 500 largest companies in the US markets. And somehow he managed to buy the index the day before a serious market crash. And he did this 3 times in a row. So just everybody, just take a guess. How much do you think Jaime would have made during this time period? I would like to ask Jaime, what do you think?
I would think that'd be quite disastrous for him. So maybe 5%?
I think over 15 years, 5% is definitely a disastrous return. But actually, looking at the slide that you see on the screens right now, this is actually the S&P 500 returns over the last 15 years. And I've kind of mapped out the day before a serious market crash, which took place in 2008, the global financial crisis, 2018, the US-China trade war, and in 2020, the very unfortunate COVID pandemic. So assuming Jaime held his investments without selling them throughout this entire 15 years, his total returns are actually closer to 85%. And that is actually not too bad an amount comparing 5% and 85%. Now, how did he actually do this? Now, this is because stock markets moves in different cycles, we all know that, but the world economy continues to grow. And reasonably, the assets in the world grow along with it. That's why the stock markets do continue to grow, asset price inflate, more importantly, and staying invested is one of the first important points that I wanted to talk about. Now, secondly, dollar cost averaging. Let's say if Jaime had been a little bit more careful and decided to invest regularly than trying to time the market and try to catch the bottom, his returns would be a little bit more different. It's closer to 150%. Now, how? This is because he benefited from dollar cost averaging. And as you can see on the screens right now, what dollar cost averaging is to take a fixed amount and invest them at fixed and regular intervals. As we all know, markets move in cycles. So if the price is higher, you buy a little bit less shares or less units. If the price is lower, you actually buy more units. But over time, your average cost is much more likely to be lower than you trying to bet or trying to time the market just to catch the lows, which it's a bit more challenging than it actually seems. So I think the next point I would like to emphasize, invest regularly. Don't be afraid of certain market swings, regardless of market cycles. Invest regularly and you will benefit from dollar cost averaging. Lastly, diversification, I really believe that's the key because it gives you consistency within the portfolio. Back when I was investing into single stocks, I wish I knew about diversification. I would have bought a few more stocks at that point in time. So if you notice on the screen right now, what this actually tracks are the asset class returns starting from 2009 for 10 years all the way until 2019. Well, as you can see, it's almost impossible to actually predict consistently what would be the top performing asset classes. It tends to change every year. But one thing you can notice is that the red box, which is a diversified portfolio of investments, tends to trend towards the middle. Sure, we may not always be at the top, but we definitely lower our chances for being right at the bottom, and we mitigate the chances of suffering a huge loss. And another thing I'd like to point out, quite interestingly, that there's a dark blue box that tends to trend at the bottom more often than not, and that's actually called cash. So if we did keep our cash in our account and don't really start investing, you would find it a bit challenging to actually make a reasonable return that allows you to beat the current inflation rate. So I think there you have it, 3 time-tested investment principles. And after you have a plan for it, as I mentioned, it's very important to think about your own personal liquidity needs, sort out your expenses, make sure you have enough of a safety net to protect yourself in case of unfortunate scenarios. And once you have that spare cash to invest, then you can start to strategize, okay, I'm ready to start, now how can I do it?
I see. Thank you so much, Jamie. I'm definitely going to keep that in mind when I start investing. So let's answer some of our viewers' questions now, shall we? We can start with those that our viewers sent in ahead of time. So someone asked, many of my friends are investing in stocks. I have also heard about unit trusts. What is the difference between investing in stocks and investing in unit trusts? Jamie?
Okay. Well, stocks are typically traded on the secondary market or on an exchange, and what you are investing in is the future perceived value of that particular company. Now, to accurately value a stock and determine whether it's a good investment, it usually takes quite a bit of time to go through the accounts, look at the charts, do your calculations, and determine is it the right time to invest in a particular stock. And to create a diversified portfolio, you have to pick up quite a few stocks together, and it usually costs quite a bit of capital. Now, for unit trusts, it's actually a pool investment where investors like you or I, we pool our money together, and this pool is actually managed by a professional fund manager or a portfolio manager who actually invests according to certain parameters, and unit trusts invest in a much broader range. So depending on what you are looking or considering at, unit trusts typically can hold between 40 to about 1,000 different assets. They could be equities, they could be bonds, they could be a balance of those. And you could invest into different strategies like maybe asset classes, geographical location, different industries. And certain portfolio managers do also specialize in different styles of investing. And the good thing is that for unit trust investments, you don't need a huge amount of capital to invest. Typically, ranging between $1,000 to $2,000 thereabouts, you can get invested into a well-diversified portfolio. Of course, that being said, stocks definitely are a lot more volatile. It does take a bit of effort to monitor your own stocks, your own stock portfolio, whereas I suppose for unit trusts, you do have professional fund managers who are taking care of the funds for you.
I see. Thank you so much, Jamie. So we also like to hear from everyone. So for those of you who haven't started investing, or even those of you who have, what are some of the things that cause you to hesitate about investing? Is it that, I can't afford to invest? I don't know how to invest or what to invest in? Or is it that you don't have the time to monitor your investments, or that investment seems very risky, or you're just not quite sure when's the right time to actually invest? So do keep your questions coming, and we will actually move on to the next few questions while we wait for the poll results. So let's go on to the second question that was sent in. So we are usually advised what to buy and which markets look promising. However, after we have bought a unit trust, often we are told not to sell. If we are to keep being invested, how do you know when to sell?
I think referring back to my first timeless investment principle, which is stay invested, it is actually very important to stay invested and ride through the different market cycles. However, I totally understand that when we look at markets falling, it is very, very difficult to actually bite the bullet. And I think what's more important at this point in time, you want to actually review what are your investment objectives. Have they changed? Has your risk tolerance changed? So here in UOB, we always have this concept called risk first, where we attempt to understand and analyze what are the risk exposures are we taking for a particular investment, and whether we can maximize that return for a certain given level of risk. So when I speak to investors down on the ground, the first thing I always ask them, has your plans changed? Has your investment objectives changed? Are you a bit less risk tolerant at this point in time? I think that's when you can decide whether it's an investment I should hold on to, or is it an investment I should sell? And of course, do consult your financial advisors to get a better understanding about what is the market outlook. As I mentioned just now, we are investing in the future perceived value of the company, of the investment, and you want to get a better understanding about what's out there in the market, what's happening in the economy before making a decision. Maybe let me paint up another analogy at this point in time. If I were to head to the door right now and I pull the fire alarm, what's the first reaction that we do? Run for the door, right? But have you ever stopped to take a time to analyze what if the fire is right at the door itself and we're running straight for it? For investments, it's the same. Sit down, take some time, take stock of what's going on before you make a decision.
Thank you, Jaime, for the very comprehensive answer. So to the audience, please be reminded that you can actually click on the poll and choose the choice that you think why you're not actually actively investing now. You should see a pop-up appear on your screen. So while we wait for more people to actually answer the poll, let's move on to our next question from the audience. So someone asked, what are ETFs and should I consider them in my investment portfolio?
ETFs, or exchange-traded funds as they are called, they are typically passive investment solutions that follow a market index like the S&P 500 or the Straits Times Index, and they are usually rebalanced at regular intervals, typically monthly. While the main benefit of ETFs is that they are low-cost investing and you get to participate in a broad range of stocks, they may not be as dynamic, having regular and fixed rebalancing intervals. They may not be as dynamic to take advantage of ever-changing market situations. So say, for example, if a market event happened in between the rebalancing date, ETFs will not be as active as per the active managers within a unit trust. So they may not be able to react in time to that particular situation.
I see. Those were some really interesting questions that we have received, and we'd like to actually we'd actually like to take a look at the results now. So it seems as though the biggest reason why many of us are not investing is, I don't know how to invest or what to invest in. 50% of the audience actually voted for that. So Jaime, what are your thoughts on this?
Well, as I mentioned just now, if you aren't too sure about what to invest in or how to invest, approach us at UOB and we'll be more than happy to have a chat with you. Well, I think there is a wealth of resources out there, be it just Googling what you are interested in. And I think as long as you are keen, the resources are available for you. And I know it's a bit difficult. We don't have much time to actually track our investments. I would advise everybody to actually speak to a professional financial advisor who really understands the markets, the product a bit better, and they will be able to help you structure a portfolio that suits your needs better. I think more importantly, don't be afraid to take the first step. Just feel free, whether you want to search for it on the internet or approach us, we are always here for you.
I see. Sounds interesting. We actually have a few more questions from the audience, so perhaps let's go to that. Someone asked, how often do I need to keep track of my investments? Do I need to monitor them 24/7?
I think it depends on the time frame of your investment, as well as how volatile the investment may be. Using my portfolio, for example, most of my longer term investments, I don't really look at them very much because I know I'm invested for the next maybe 15 to 20 years. But at the same time, I also do have shorter term investments to capture market opportunities. The time frame can be 1 month, 3 months, 6 months. It really does depend. I would probably keep a closer eye on those. But regardless of the investment time frame, you always want to keep yourselves aware of what's happening in the rest of the world, what's happening in the economy as well, read the news, just so you get an idea, or maybe you might pick up something that could positively or even negatively affect your investments.
I see. Thank you, Jaime. So going back to the poll that was conducted earlier, other choices also were quite popular. So people did choose, I'm not quite sure when is the right time to invest. So Jamie, what are your thoughts on those?
Yep. I think about the timing of the investments, right? Running back to the 3 investment principles that I shared with everybody, that never really is a right time to start investing. It's almost impossible to actually capture the market at the highs or at the lows. So I think firstly, it's very important to stay invested and of course, to actually benefit from dollar cost averaging by investing at regular intervals rather than putting a large lump sum in at one go. I think it really depends. Investments it's a very personal journey, right? Nobody can tell you that you are ready. But I think it's good to really sit down, take stock of your finances and find out whether you have the additional time, additional funds. Maybe these funds can be put to better use. So I think since there is never really that kind of perfect time, right? But if you never start, you would never get anywhere.
Okay, sure. Let's move on to the next question from the audience. Would you recommend a beginner to go with a financial advisor or a robo-advisor, and why?
Okay. Maybe I'll touch on the topic of robo-advisors first. So what robo-advisors are is that they are automated algorithms, right, that actually formulates a portfolio for you. And they're kind of like passive in a certain way. They may link you up to an index or maybe a basket of funds. Now, robo-advisors, of course, key benefit is the low cost, and they don't usually involve much money to invest. But I would say that they can handle mainly very straightforward investing. So if that's what you're looking for, that may be beneficial for you. But however, for slightly more complex scenarios, like for example, if you were to come up to me and tell me that, my financial situation has changed and we need to make the adjustments, I think this is where having the human touch would matter a little bit more, because having a financial advisor or having somebody sit down, speak to you, he's able to empathize with actually what you are going through. So I think there are pros and cons about either one, and why not actually just have a look at both and really see which one suits you better.
I see. So I think many of us who are beginners can relate to having a lot of fears about investing in markets. So going back to our initial poll that we had, we can go on to some other reasons why people don't want to invest. And it seems as though there's a lot of questions on, I don't have the time to monitor my investments. Investing seems very risky, very scary to me. So Jamie, what are your thoughts on that?
I think almost every investor that I speak to, they'll always share with me that investments are very risky. I don't want to take on too much risk. And I'm very glad that from the polling results, investments are risky is not the highest investment objective that we have here for tonight. Maybe to share a concept with you, almost everything we do entails some form of a risk. And very sadly today, just opening our doors and heading out to buy ourselves a meal or have a good meal also entails a form of risk. But why do we still do it? It's because we believe that the chances or the probability of a highly unfortunate event is very, very low. We are essentially able to mitigate the risk. An extreme sports person, how does he mitigate his risk? That's a very risky sport that he does. He trains and trains and trains until he can't get it wrong. Investments are no different. Well, while it's challenging to accurately predict returns, but we can measure risk. That's why here in UOB, we always focus on what are our risk exposures first. It's what we call the risk-first approach. And after which we can determine what is the maximum risk that you are comfortable with taking, and only then do we try to make your portfolio more efficient and maximize your returns for that given level of risk. But for those of you who are very keen to start and still not too sure, is it the right time, or maybe just a bit more cautious at this point, it's my great pleasure to actually share with you an investment solution that UOB has recently launched. It is called Simple Invest, and it's designed to make investments so simple that anybody can get started and only takes you a couple of minutes. So before I get into the details, I'd like to share with you a very short video. So please enjoy.
Just the other night, I spent about $100 on dinner with my friend. You and I end up spending that kind of money every now and again on shopping, catch-ups, and entertainment. But do you know what else you can do with that $100? You can kickstart your investment journey. Many of us know it's important to invest for our future, but we may be making a lot of excuses about why we're not quite ready to start. I don't think I can afford it, investing is too complicated for me, it's risky, isn't it? Maybe now it's not the right time. Do any of these sound familiar? Well, I've got news for you. UOB has made investing mighty simple. So simple, now anyone can invest. UOB Simple Invest is a simple new way for you to invest with just a few taps on the UOB Mighty app. See that little icon right there? That's the one. It takes just $100 to start, and you don't have to be a financial expert either. Simple Invest allows you to draw on the expertise of renowned asset managers that manage almost 10 trillion US dollars in funds. This way, you don't have to research the entire universe of investments yourself to decide what to invest in. And if you are nervous about investing and think it's too risky, don't worry. With Simple Invest, all you need to do is choose from 3 simple solutions, depending on how much risk you're comfortable taking. What's more, you have the assurance that the solution you pick is actively managed and watched over by experts to mitigate the risk you take with your investment. Let's do a little test run, shall we? Log into your UOB Mighty app and tap on Simple Invest. Decide on your investment objective and how much risk you're willing to take. This will help you choose from the 3 simple solutions. For example, pick the liquidity solution if you prefer to play it safe while trying to beat inflation by investing in low-risk, liquid assets. This solution invests in high-quality bonds, government securities, and bank deposits that help you get higher returns than short-term saving deposit interest rates. Or if you seek reasonable returns and a regular stream of income and can take moderate risk, you can find balance by considering the income solution. This solution invests in various income-yielding asset classes to generate regular payouts for you. Finally, if it's long-term capital growth you're looking for, you can go for the growth solution. This solution invests in equity funds that tap on investment themes shaping the future of the world. Think sustainable investing, the growth of China, healthcare, artificial intelligence. Now that you've chosen the solution that suits you, you have the option of investing your funds at one go or as a recurring monthly amount. It's up to you. Simple, isn't it? See? Investing isn't this intimidating thing that only the financially savvy can do. It can be simple and straightforward for anyone. So don't wait any longer. Letting your money sit idle will only result in inflation eroding its value. Download UOB Mighty, and for as little as $100, you can start investing today, for tomorrow, and beyond.
I hope everybody enjoyed the video that we just seen. And right on your screens right now, if you'd like to find out a bit more information about Simple Invest, just feel free to scan the QR code. But rest assured, if you miss it, we will flash the QR code again at the end of this session. Okay, so Simple Invest, what does it do for you? It allows you to actually choose from 3 investment solutions based on your specific investment objectives. So we have Play It Safe, to find balance, as well as to seek out growth opportunities. And these days, right, Simple Invest actually allows you to invest from as little as just $100. And that would pretty much cost about the same price as a nice meal out with the family. So it is a lot more accessible to a wide range of investors out there. Moreover, if you are concerned about, or maybe find it challenging to understand what's happening within the market, Simple Invest also taps on the expertise of very seasoned and experienced fund managers like Fidelity International, JP Morgan Asset Management, and UBS Asset Management. And these are the professionals that really have teams working around the clock 24/7 to keep an eye on our investments.
Sounds very interesting. So we do have some questions from our viewers about Simple Invest. So let's answer those. So we have a first question. How is Simple Invest different from investing into other unit trusts?
Okay, Simple Invest, right? It's a solution that allows you to actually select based off of your risk tolerance and your investment objectives. When you invest into just a typical unit trust, right, they will tell you what is the investment objective of the fund. So like for example, they invest into Asian equities or US equities. So you kind of have to have a good idea about what's happening in the market to be able to select the right unit trust. And in the universe of unit trusts, there are probably thousands of them. how do you actually select the right one for you? Well, Simple Invest actually solves that issue for you. So just by selecting, let's say, for example, the income portfolio, the solution actually gives you a very well-diversified portfolio between bonds and equities, and it focuses on actually generating constant dividend income. And of course, for the growth portfolio, slightly a bit more aggressive. It has much more equities within that portfolio, just so that you can enhance your total returns.
Thank you, Jamie. So we have another question on Simple Invest that just came in. So the viewer asked, is Simple Invest a robo-advisor?
Well, robo-advisors per se, right, they are based off of automated algorithms, right? And as I mentioned just now, they are usually linked towards a passive index. And robo-advisors really do just take away the human element. Humans, as humans, when we talk to each other, we are able to empathize with what's going on, how you're feeling exactly at this point in time. Whereas for a robo-advisor, right, I think it's more suitable if you are looking for a very straightforward investment solution. But if you want something that requires more complex calculations or maybe a bit more of a personal touch, I think that's where Simple Invest actually comes in to actually kind of like simplify the idea for you so that you can actually invest based off of your investment objectives, right? And of course, we're also here to help out to actually find out or help you maybe identify which of the Simple Invest solutions suits you better.
Thank you for the explanation, Jamie. So let's move on to the next question. Do you agree that the best fund managers never beat the S&P 500 in the long term?
Well, I think this is a very interesting question. So there's always a huge debate about passive investing versus active investing. And I think it's a pretty close fight. Some years you get the passive managers who just follow the index. They do beat the active managers. But when I find that when market situations are a bit more dynamic per se, that's when active investing does play an element of truth. So what we want to do, or what Simple Invest can do for you, or unit trust as a whole, it kind of like marries the pros between passive investing, because Simple Invest, they do have active managers, but they also do invest based off of specific parameters, and they tend not to deviate too far from those. So I think it's a pretty close fight, and really depending on which year you look at, sometimes passive may beat active or active may beat passive.
Thank you, Jamie. So we have other questions on Simple Invest, such as what are the fees? Are you allowed to also switch solutions?
Yes. For Simple Invest, it's actually a low-cost, low-capital investment solution. So for as little as $100, you can get started. And you can choose to invest on an ad hoc basis when you choose to. It can be a one-time. You can even choose to invest at regular intervals, all for a low cost of a one-time sales fee at 0.8%. And there are no platform fees. So the longer you hold on to your investments over there, you don't find it getting more expensive just to hold on to your portfolio. And with regards, a different question that we usually get, is there any lock-in period? Well, the answer is no. You can actually buy and sell your investments anytime that you actually like. And the good thing is that if you switch between the income and the growth portfolio, there's also no switching fee involved. The liquidity solution, there is no initial sales fee.
Thanks, Jamie. So another question that we have from the viewers, markets have been falling lately. How do we know when's the best time to invest?
Yes, I think one of the biggest concerns in our mind is that markets have been slipping quite rapidly. Some of the reasons I believe we are quite familiar with. I think touching back again onto my 3 investment principles, there never really is the right time to invest. But we know markets can be a bit more volatile, a little bit more risky at this point in time. I suppose one thing that you want to try and understand is, are you comfortable with this level of risk to actually jump into the equity markets at this point in time? If not, I would say, why not diversify your portfolio? There's really never a bad time to invest. And I think some of the well-diversified portfolios are actually holding up a lot better as compared to just the single equities itself.
I see. Thank you so much for your very comprehensive response, Jamie. So another very curious viewer has asked, what are your thoughts on investing in China markets? Are there any other markets that you would like to look at?
Well, I think in terms of deciding which market is the best time to invest in, we don't really just look at the time factor. There are so many other things in play or so many other parameters we want to look at. We talk about, is it a good value? Are we paying the right price at current levels? What about the economic activity that's happening in China right now? So other geographical markets, I can't say for certain which is the best market we want to invest into, but if you were to actually turn into our semi-annual investment outlook, you would get a much better idea about why we like certain regions, certain countries, why do we like certain asset classes, and the reasoning behind that. And you also get a much better understanding about how we come up with our specific market calls. So definitely do reach out to us, and we could actually run through with you on what is our market outlook.
Thank you, Jaime. So I think with your response to that question, I think a lot of people would think that you will need to really keep abreast of what's happening in the markets right now. And so then there's a question on how often do I need to keep track of my investments? Do I need to monitor them 24/7?
Well, monitoring your investments really depends on the time frame of your investments as well as how volatile they may be. So for my investment portfolio that I plan for retirement, that's very long term, 10, 15, hopefully 15 years, but maybe 20 years. I don't observe it as much, maybe once every 6 months, if possible. But I do have shorter term investments that I try to capture market opportunities as well. I'll probably keep a much closer eye on those. But regardless of the time frame, I think it is very important to always be in tune with what's happening in the market, how the economy is doing, and how certain stocks are moving, just so to give you an idea, because you might catch something that potentially could affect your investments.
I see. Thank you, Jaime. So I think one other question that we have regarding Simple Invest is, who do you think is suitable for Simple Invest? Is it only beginners or is it for everybody?
I think it is suitable for a wide range of investors over here. Like, let's say for those who want to start out with a smaller amount, I think Simple Invest is very suitable for you. Or maybe there are investors with much larger amounts that just really want to focus on a specific objective like income, have liquidity, or growth. Of course, if you wanted a more bespoke solution, like a well-tailored suit, I believe this is where the financial advisors come in, get in some of the specialists to really sit down and have a good chat about your finances, your needs, your objectives, and overall structure a more comprehensive portfolio. So there isn't really Simple Invest is suitable for you or for me. I really think anybody can invest and benefit from it.
Thank you, Jaime. So next question from the audience. Can you tell me more about active investing versus passive investing? What does that mean and which is better?
Okay. Well, passive investing basically means you tend to follow a benchmark. Typically, it's a stock market index or any index that's available out there. So you track it religiously, and because the market weights tend to change as asset prices shift, right? So the rebalancing is done typically on a monthly basis, just so that the market weight of the investment accurately replicates that of the index itself. Now, for active investing, it is pretty much left to the portfolio manager or the fund manager to determine what investments would suit or give the better return. And sometimes for most of these funds, you will get some set parameters. So for example, you cannot invest into too many equities, or you must hold a certain proportion into bonds or cash. There are also much higher level or much riskier funds where active managers are given the discretion to do almost anything they want. Of course, those would tend to be a little bit more risky because you are essentially investing in the skill of the portfolio manager.
Thank you, Jaime. So the next question from the audience. Robo-advisors remove human elements and may be a better form of safe investing. Do you agree?
Well, for robo-advisors, they tend to be set off of that fixed automated algorithm, right? So the solutions that they come up probably wouldn't differ too much from investor to investor. So let's say if me and Tianmin, we do the questionnaire within the robo-advisor, we may get a portfolio that is relatively similar. But our needs are very different, right? So I think having different investment objectives, different needs, even a different frame of mind at that point in time, sometimes just having that human element will actually guide you to a better investment solution overall, rather than just direct robo investing. Well, I'm not saying that either one is good nor bad. It's just really a matter of preference.
I see. Thank you, Jamie. So we are coming to the end of our webinar, and we'll take a few more questions before we do. So let's take a few more questions from the audience. Let me see. Okay, a quick question. Who manages the Simple Invest portfolios? Are there management fees? If so, what are the fees?
Okay, so in our investment Simple Invest portfolios, we've got a variety of different funds within each of the solutions for income and growth. And some of the portfolio managers that we work with include Fidelity International, UBS Asset Management, we work with First Frontier Investors, we work with JP Morgan Asset Management at the same time. So in terms of management fee-wise, right, the real out-of-pocket fee that you will see is the initial 0.8% sales charge. The management fees that we talk about are actually levied at the fund level itself, but overall, Simple Invest is designed to be a low cost and low capital solution overall. So I think definitely compared to, let's say, fully actively managed funds, the management fee would be slightly lower.
I see. So last question. Does Simple invest in equity or bond unit trusts or directly in stocks and bonds themselves?
Yes, that's an excellent question. Thank you very much. So Simple Invest is basically a basket of different bond or equity unit trusts packaged into one. So for the income solution, the unit trusts that are inside that portfolio itself are usually balanced portfolios, meaning we have both equities and bonds inside there, and they usually target to pay consistent dividends. That's why we call it the income portfolio, and as opposed to trying to give you very aggressive capital gains. For the growth portfolio per se, because we want to capture market opportunities, you would expect to see more equity unit trusts within that portfolio.
Sure. Thank you, Jamie. So we are coming to the end of our webinar tonight. So we'll once again like to thank Jamie for sharing his experience and insights about investing. So I've learned a lot, and I'm sure everyone who tuned in today did as well. So before we end the session, we would like to invite all our viewers to share your feedback with us about tonight's webinar. You will see a feedback form pop up on your screen right after this, and we'll appreciate it if you could take a minute or two to let us know how we did. So thank you again, everyone, for joining us this evening. It was a pleasure having you with us. Good night.